You're listening to Carrie Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to watching the Financial Survival Network. I'm Carrie Lutz. Well, market, really iffy right now. It's getting close to support. If it breaks through here, we could see a major decline. The dollar is booming. It's at multi-decade highs, and the war continues on, and so does stress and anxiety. Many of you out there, I get your emails, you're worried about what you need to do to protect your wealth or just to try to do something to safeguard your family, whatever it might be. David Stryzewski is back with us. You find him at myspg.com. David, great to have you back on. So we're in a world of woe, a lot of trepidation, a lot of fear, a lot of loathing. And what do you do in an environment such as this, which is unique to many of us? We, very few of you were alive during the Great Depression, probably none, I would venture to say, or almost none. Very few during World War II. We've had a lot of turmoil and a lot of major disruptions throughout history. But maybe we've gotten spoiled over the past 50 odd years. Things have been very stable. So what's your take on what's happening now, and what do you do about it?
Well, Carrie, it's great to be with you here today from beautiful Kirkland, Washington. So that's the sunniest part of our talk probably today, where we're going to probably get into some of the storm cloud stuff that's happening here. And maybe Jamie Dimon said it right a few months ago that he foresees a hurricane coming. And I just want to parallel off that real quick, because here's the thing about a hurricane. Tornadoes show up and they destroy really bad. Hurricanes show up and they destroy. The difference is that we have time when a hurricane comes. Something's off in the distance as a big, storm, and then it becomes a tropical storm, and then it's a 1, 2, 3, 4, 5, hopefully not. And then we know when it makes landfall. So I think that what we're seeing right now is the convergence of many different crosswinds. We're seeing many different things come together right now at a very, very unique time in history. And so I have 5 things that I primarily look at that help me to determine and follow kind of like what's the market doing. So to your question, what do we do? Well, we need to be able to analyze and internalize what's actually taking place if we're actually going to do something that's going to make a difference for our situation and circumstance. So as an example, inflation, we're obviously at 40-year record highs right now. It's debatable whether that's been curbed or not, but here's what we know. Inflation is a very real thing. It's affecting everybody here today. And we're seeing it, quote unquote, go down. But what's interesting is that food and energy have been the largest drivers of that inflation. And they've kind of been tapering back, at least the gasoline part, because people haven't been consuming as much. And they're sort of right sizing in that regard. But we've got a lot of inflation in other areas, which we'll get to in just a moment. So we've got inflation, we've got interest rates are the second part to this. And so what we're seeing right now, and we know, is that interest rates are changing. And this is a really big problem for people trying to buy a home, for businesses that need to metabolize debt or want to buy something, or new, tractors or anything. We have a debt market. And so when things get tighter, and by the way, this is a real deal right now. They're raising rates and they're also reducing the monetary supply in them too. But the third thing is, what's the Federal Reserve doing? So that's what they're doing. They're raising rates. And so what the Federal Reserve can do is they can focus on the demand portion of supply and demand, but they don't affect the supply side. And so that's what I really want to focus on with my time or conversations is, let's talk about some of the supply challenges, but the demand issue is what the Federal Reserve adjusts. And so when you raise interest rates and you make it more expensive to purchase a home, guess what that does to demand? it tends to curb it. What happens when the Federal Reserve has to cause debt to be more expensive? Well, everything else gets more expensive because corporations pass that along to the consumer, or we have flush outs, like I think that we're going to see here in the next 6 months, year, 2 years, going to be happening here. So we got the Federal Reserve, then we've got corporate earnings. Now, this is an important one to be paying attention to, like right now. And what's interesting is I've been saying this all year, and now most analysts that are coming on TV, like I was just this morning, are talking about, hey, we know that corporate earnings are going to have to come down. Here's why. See, the Federal Reserve has been giving us information, and all the information that we follow is in hindsight. So we look at CPI from the quarter before, we look at from the month before. So we're looking backwards, and the data hasn't been strong enough to indicate clearly, at least, a recession, at least when we're in the middle of a midterm election year. Okay, so we've got new definitions going on what a recession is, but corporate earnings have been assessed to be strong. So there's an equation that's important for people to understand. That's price to earnings. And so this is part of how we determine how much we pay for a stock. If you were buying two different companies, you wouldn't want to buy one that's more expensive and makes less. You want to try to find the ones that has the best PE, price to earnings ratio. And so we've seen price come down earlier this year, but earnings, that's what we're talking about, earnings has not had a real recession yet. It hasn't had to come down. Why? Because the recession, the data hasn't been in. And so analysts, third and fourth quarter here, they're going to have to go down with this. We're still in double digits. I'm thinking low single digits. And this is going to cause us to test those mid-June highs there, or lows rather, of June 16th. And I think we're probably going to be seeing 15 to 20% lower than that as the quarter proceeds, just as a result of the corporate earnings part getting reduced because the analysts have it wrong right now. Then the last part to this is the geopolitical risks that we have. I don't care whether it's COVID, it's war in Russia, potentially China and Taiwan, way bigger issue than anything going on in Europe is, even though that's a really big deal. But the geopolitical components to this are significant, and they are changing rapidly. And so when we look at all of this, I just like to say that, if you're on an airplane and you're flying, what's incredible is that there's a lot of pilots today, if I can use this analogy, of money managers and systems, and they have things just on autopilot. They're doing what they did before. Allocations may be balanced a little bit different now as a result of some changes that are occurring, but not a lot of variation to them. They're still heavy in corporate bonds and debt like this, not understanding the big challenges that interest rate raises will have for those bonds. We can get to there in a minute, but we're seeing a time frame here where everything is changing. And I believe that there is a hurricane in the distance, and we're flying on autopilot right into this thing. And so the question is, would it be valuable to have a pilot that understands how inflation works, how the interest rates work, how that couples with how the Federal Reserve's moves, how that works alongside of the corporate earnings and what the estimates are today and maybe where they should be fair valued. And then lastly, those geopolitical components, because all those things do this tug of war on supply and demand, and where the bulls and the bears fight. By the way, the bulls are what pull us to the top and the bears are what beat us up here. And so we need to be cautiously optimistic right now, but I think more caution than optimism at this point in the cycle.
Okay, so caution is the byword, and basically don't stick your head out of the foxhole because it's going to get shot off if you do. But so what do you buy? Is it treasuries? Is that the protective mechanism? Gold, silver, Bitcoin? What is a poor beleaguered investor to do, David?
Don't just survive, thrive. The Financial Survival Network.
Torque Resources is an exploration company establishing a portfolio of premier copper-gold early-stage projects in Chile. Torque's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita copper-gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration exploration system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torque trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqueresources.com. That's torqueresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
I love that question. So I like everything at various times. And so I want to be financially agnostic because there's no deity in money. There's no best answer all the time. Here's what I'll share with you is our rhetoric or the way that we view where to invest and how to invest. See, every person is unique. They're individual. My risk tolerance might be different than yours, even though we may think really similar. Your age difference between mine and yours might cause us to have different investment strategies, right? And so there's a number of these factors that come in, our time horizons. But we like to look at asset classes in three different ways: cash assets, protected assets, and risk on or return assets. And so cash assets are going to be things like, cash in the bank, maybe short-term CDs, but short-term treasuries as well. I mean, shoot, if you can get 3.5% almost right now on a 2 to 3 year treasury and get deferred taxes on that, that's not a bad deal. Getting capital gains, owning individuals stuff. So that's an okay way to do things. I don't think the Federal Reserve or the Treasury is going to default on those. They've been keeping this thing going for a long time. They certainly will keep treasuries going and have the ability to keep that going, indefinitely. There's a big challenge, though, as we move to the protected assets. Now, the protected assets traditionally that question's answered by what bond portfolio do you want? And so a bond portfolio, we just have to understand a couple of things with bonds real quick. One is that bonds can lose money. They're not just some guarantee. Okay, they're an investment just like everything else. And so the worst possible case for a bond is that a company or an organization goes bankrupt and you're paid back zero. Think Lehman Brothers, Washington Mutual, Enron, nothing. Way too many stories on those, actually. The other part to this is just to understand, the interest rate component to this and what the Federal Reserve is doing. How does that hand in hand work together? What happens is the Federal Reserve, it's a seesaw. When the Federal Reserve raises interest rates on one side, the value of our bonds go lower. It's called net present value. And so the net present value of bonds reduce in an interest rate escalating environment. And so if we find ourselves in a time like the late 70s when Paul Volcker got rates up to 20%, owning bonds would be like the worst idea ever. I don't think that we have to get there, but this is really important. So you ask the question, where do we invest? So on the protected assets, I think that's one of the more important things that people are not having a lot of conversations about. So I am not excited about corporate bonds. Why? Because the interest rate adjustments that can happen are default. But I also care about credit-worthy companies that might become insolvent, might file bankruptcy, might be a zombie company. I definitely don't want to own a big mutual fund that has a little of everything because it has the good and the bad within it. If you're going to make a bond portfolio, which we have one, you need to have individually selected bonds. You need to know that they've got the right criteria for the right reasons. You're looking at, risk, return, duration. So we want to be on the shorter end of that. The big thing, though, that we found is that there's actually, and I believe this is true based on math and science, there's never been a better time in the history of the world to own a fixed indexed annuity, a growth-oriented fixed index annuity. That's an insurance product, by the way. And so they have the ability to give you participation in market indexes like the S&P 500, think like 50% on the upside, but more importantly, zero on the downside, guaranteed. And so it's having those types of hedging strategies within a portfolio that are really going to make a big difference right now. And so if we can get reasonable rates of return on the market, think whatever the 10-year treasury is doing, plus about 2%. That's what they've historically done. That's what I've been taught. That's what my research shows to me. Right. And so that gets a lot closer to what real inflation numbers are, where even like that 2-year treasury, though it's at 3%, it's not the 5, 6, 7, 8% that we really are losing buying power with this year. And so we've got our protected column. And this is important because as we get a little bit older, and there's so many people here today that are either retiring, resigning, they're getting laid off. That's another thing that's going to be coming right now with these corporate earnings coming down. They're going to have to right size their organizations, and they're not in growth mode anymore. And so, we find ourselves in a really unique place. So I want to jump over here to the risk assets real quick, and just finish it with saying that on the risk side, that's our R, CPR, cash protection risk. So on the risk return side, we want more individual selections. So in our firm, we've got about 30 different portfolios. That bond one was one of those, so about 29 others. And so, we have 6 different individual stock strategies. So there's certain ones that we'll deploy at various time frames. We've got a metals portfolio as an example. That's a really good idea right now, even I think better than owning metals straight up, because the metals portfolio has the ability to produce the metals. They also own the mines, the rights to the minerals. And so there's value intrinsically within organizations like that can produce. And then they're also going to ride the variations of those waves up and down. I prefer silver over gold, though, if you're asking me.
Well, I was going to ask you, but now you told me. So why?
Okay.
What's the preference of silver over gold?
Sure. If I can recall the research I've done, historically speaking, when a gold standard was established, supply and demand determined the price of the silver versus the gold, or their relationship. So it was about 14-1, which has historically been across the board, 14 ounces of silver for every 1 ounce of gold.
Right.
And so that was supply and demand. Today, and I'm not as current on this as I should be because you asked me the question, but I think it was last year, we were able to produce 10-1.
Right.
10 silver for every 1 gold. But here's the interesting thing about, so 10-1 should be the ratio, but here's the interesting thing about silver. Inside of these wonderful computers that we're talking on right now and the servers that are processing all this, those circuits are connected with silver. Silver conducts energy very, very well. And so it's got this commercial purposing to it. And so where gold ends up in a ring or jewelry or in a safe someplace, typically, silver gets used and it's gone.
It's
so the actual remaining factor is less than 10-1. Sure. Then we get into just the further component to this, and we look at the ratio of gold to silver right now. We got like 1,700 plus on gold, and we're looking like $17 on silver right now, $18, something like that.
18, 19, I think, yeah.
80-1. So you tell me, supply and demand is a real factor. I don't care if the markets recognize it right now. There are inefficiencies that we can find at various timeframes. So that may be an idea for someone out there. But again, the miners have an opportunity to do some things in a really wonderful way. It just seems like the price of silver has been depressed on a global scale because they don't want to have the price of consumer electronics to go up as much.
It could be the case, and believe me, I'm with you. As playing a little bit of devil's advocate, I see a metals portfolio kind of being really, really important now.
Totally agree.
Because, it is the ultimate fear trade, the ultimate safe harbor asset. Well, I think you covered a lot, and for a guy who's into conventional stuff, you're not afraid to cross the river and go onto the dark side, which many in your esteemed profession definitely shy away from, because let's face it, there's no real commissions income potential when somebody buys an ounce of gold and they just throw it in the safe or in the vault, whatever. Hey, David, people want to find out more about you, connect with you on the web. Best way to do that?
Sure. www.myspg.com. And I teach a lot of classes here in local colleges in the Seattle area on things like Medicare planning, Social Security, taxes, principles of retirement planning, how to ride bulls and tame bears. That's a good idea for a new book coming out here. That's my book. And so we're doing a lot of that. We'll have a lot of information on that, webinars and such available for those that are out of state, of course. But also we'll just be, up and down the I-5 corridor, 405 area here in the greater Seattle area. So,
yeah. All right. Excellent. All right. Been a pleasure as always, David. Got a question for David? Shoot me an email, kl@kerrylutz.com. Make sure you go to the site, financialsurvivalnetwork.com. Sign up for your free newsletter. David, really appreciate you coming on. And by the way, let us know how you are coping with this uncertain inflationary, stagflationary environment. Have you quit your job? Are you part of the Great Resignation? Let us know all that. KL@KarrieLutz.com. David, appreciate it. We'll talk to you again real soon, man.
Thank you, Carrie. Pleasure to be with you always. Take care.
Thanks for listening to Carrie Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.